Thank you, Richard. We're going to do a quick change here. Bob White's coming up. So there's a lot of talk these days in our economy about disruptors, and we hear about Uber and Airbnb. Within our own industry, however, I would argue that Bob White has been perhaps the most significant disruptor in the collection and distribution of data in real estate. Bob is the founder of Real Capital Analytics. When he set up the business a few years ago, people said, why do we need all this data? And now we can't live without Bob's data. When Oliver invited me to create the program, one of my first calls was to Bob. He is an outstanding speaker, and he's going to share with us his view and RCA's view of the global capital flows today. Bob, please.
Thank you, Brad. That was very kind of you. And thank you for having me here this morning. I'm very pleased to be here and share with you a little bit of our view from the world. As Brad told you, my firm tracks transactions globally. We have a fairly narrow focus, just looking at capital, debt and equity, capital flows, pricing of assets, ownership of commercial real estate, and how that affects the marketplace. So I'll start at a very broad picture of the globe and where we're at today. And at the risk of looking like a TV weatherman, this is basically a map of transaction activity over the past year, 2016 year end compared to the prior year. And the blue, the darker the blue, indicates more of a chill over the marketplace, where we saw declines in transaction activity. The orange, and the darker the orange, means the greater increase and heating up of investment in markets. And you can see that overall there was a chill that went throughout the globe, certainly in most of the largest markets. The relatively few places that we saw increases in transaction tended to be in Southern and Eastern Europe, the developing markets in Asia.
So keep an eye out back here.
U.S. overall saw about a 10% decline in transaction activity over the past year compared to the year before. The declines in Europe were actually far more severe, over 20%. Although if you dig into that, it was primarily in the UK, France, and Germany. If you took those markets out, it's a much more positive story throughout Europe. Asia is very similar. The declines overall in Asia were a little more modest than either the Americas or EMEA, and they were primarily caused by tremendous slowing of activity in Japan, as well as in Australia, which had been one of the hottest markets over the prior years. The chill that's come over the market, there are a number of factors for it. I will say one of the factors it's not is lack of capital. I was happy to see Chris Ludeman, who heads the global capital markets business for CB, in the room. His firm was involved in, we just issued a ranking and report yesterday. They were the most active agents around the globe, involved in well over a quarter of all the deals, and I'm sure he would back me up. The problem is not for lack of capital or investors out there. In fact, if there's any trouble, it's on the sell side, finding sellers in the market that are willing to sell. We have very well capitalized investors that are perfectly happy to sit with the assets as the market may be cooling a bit. Just look at London. 50% decline, cratering of investment activity over the past year, but only a very modest decline in prices. There are very few sellers there. The market is, able to withstand that drop of decline without causing a big change in pricing. And despite the chill that we've seen over the entire globe, we found very few areas where we've seen prices move negative. In fact, even in the U.S., despite the 100 basis point increase in interest rates since November, we have found few to almost no instances where cap rates have started to rise as a result. Again, tremendous amount of capital, the weight of that capital that continues to hang over the market. So the mechanism is slower transaction activity as opposed to falling prices. And I will say, just looking at our data in the first quarter of this year, that's still very preliminary, the declines are going to be more severe. and that may scare investors. Investors are being very cautious at the moment. They're very heightened to risk, which I think is a good thing. If it was the opposite, I would be much more worried that we were close to the end of this cycle. So investors are attuned to risk. They're not ignoring risk. They are very much attuned to the rich pricing in the global markets. And we have seen over the past year very much of a plateauing of prices for prime assets in gateway markets. Again, we haven't seen it fall, but we haven't seen investors pushing prices in those markets as well. Certainly the geopolitical situation has introduced a lot of uncertainty into the marketplace. I'm a real estate guy and focus on capital, so that's not my specialty, but certainly that is an influence in the marketplace. And as Richard mentioned earlier, we are 7 years into an up cycle. This cycle is getting old. The average cycle has been less than 7 years. Longest in the US has been 10 years. So there's a school of thought out there that we're due for a correction. And certainly over the past year on a global basis, 2016 was the first year we saw transactions fall since the Great Recession in 2009. And certainly that's playing into the marketplace. However, if you look at global volumes, and I've split the volume levels, the dark blue is single asset transactions. The lighter blues are portfolio and entity deals. Why that's significant, and this excludes development sites, only income producing properties are included here, is that investors are being very strategic. There are fewer investors making these huge macro bets with portfolio and entity deals, but there is only a small decline in sales of individual assets. Again, a very strategic view of the marketplace, another indication that investors are being heightened to risks. They'd rather buy a single asset than buy a whole basket of assets in this marketplace. Now, I mentioned this is just income-producing properties, which totaled a little over $800 billion last year. The other part of the equation that brings the total up to about $1.3 trillion globally are sales of development sites. Largely, by far the largest component of that are sales of land rights in China and throughout Asia. When you look at Europe and North America and the US specifically, one of the greatest pullbacks of investments over the past year have been in development sites. This market is largely not overbuilt, and there is much more restraint on new development that has entered the market over the past year than previously. Again, that's something that's counter to what we've seen at the peak of other cycles, where developers were building with abandon. Investors are also being much more conservative with leverage. When we look at the underwriting, specifically in the US and other parts of the globe, it's actually very conservative based on historic standards. So we're not seeing a market that's over-leveraged at all. Again, another factor that has been present at other peaks of the marketplace. So even though this cycle may be well into its 7th year, I'm not so sure it's going to die of old age at this point. We have seen a new order in the real estate investment markets over the past year. Many of you should be very proud that Germany, for the first time in our decade of tracking this data, overtook the UK as the most active investment market in Europe. I think that over the coming years, Germany and the UK will be going back and forth as the lead in Europe. But one fundamental change that we saw in Asia is China, that if you exclude all the development activity, just the sales of existing income-producing assets totaled almost $35 billion, which made it the most active investment marketplace throughout Asia-Pac. First time ever, and that's a significant change. And I think that's a fundamental shift that's only going to widen in the coming years. What that means is that there's a secondary market. There's more liquidity for assets in China. It's opening up. There are now core investors investing in China, which certainly is a new phenomenon over the next couple of years. So that's a new market to capture attention of even core investors. Again, you can see that the largest market, the top 8, largely had the greatest declines in activity over the past year. Arguably, these are the markets where investors were worried that pricing was the richest. When you look farther down, you see far more positive gains as investors are looking to new markets. I would say some of the success stories over the past year where investors are seeing gaps and an arbitrage opportunity, if you will. In Asia, it would be Korea and Seoul, which saw record amounts of transaction activity. In Europe, Amsterdam, the Netherlands looked like a relative bargain, and we saw significant rise of investment there. As we record all these transactions, we pay particularly attention to the owners and their joint venture partners and try to track their source of capital. The globalization of the market has been an ongoing trend for the past 2 decades and certainly has accelerated far more just in the past decade. Like the overall market, we saw a slight pullback last year. So in 2015, nearly 1/3 of all the transactions we tracked we could directly attach to some cross-border equity component. This past year, that declined a bit, down to 28%. A little bit, more or less in line with the overall market, maybe slightly less. The flows of the capital have changed significantly. See more orange lines on there, which indicates capital from Asia into the Western markets. And of course, those have been some very headline-making deals and captured a lot of attention. When you look at the destinations, the U.S. has gained as a percentage of attracting all of that capital at that moment in time. The U.S. and actually over the past 6 months, Canada has been growing in attracting that capital. I'll say, having traveled throughout Asia and speaking to other investors a few weeks ago, Germany is at the top of many of their investment target lists. But when you look at the sources of all this cross-border capital, and again, we track direct investment. So this is not accounting for investment into funds and REIT shares and things like that. But really, for the first time ever, this capital is being originated in equal proportions between Asia, EMEA, and the Americas. And the growth, of course, has been in Asia. And that's what's been capturing the attention and many of the headlines. Europe, though, it's overshadowed the amount of capital that we're seeing coming out of Germany, particularly into the U.S. and throughout Europe, which is really the only other area where we're seeing an increase in that market share. Now, there's a mistake that all this capital from Asia is Chinese capital. And, that's not true. It's only part of the picture. The capital coming from South Korea, Malaysia, certainly Singapore, the potential amount of capital that could be coming from Japan, the reemergence, I should say, of the superannuation funds out of Australia is significant. So even though the capital constraints may curb some of the appetite of Chinese investors, they're just part of that overall Asia capital flow story. The capital flows on a global basis remain very, very concentrated. We've seen it disperse only slightly over the past year. New York and London combined account for almost 1/4 of all that investment capital. London has fallen precipitously over the past year, as you might imagine, and New York has taken the top place. These top 30 markets account for over 2/3 of all the global cross-border capital activity. So it's very, as big as the world is, the destination of that capital still remains very concentrated. And of course, that's why pricing is so priced to perfection, if you will, in these markets. I don't have to reiterate this that you already know. Cap rates are as low or lower than they ever have been in the major global cities. And we have not seen, despite the pullback of transactions, any real change in cap rates at this point. So that's causing investors to look to alternatives. One strategy that many are doing is looking at property sectors that they have not been as active in previously. The logistics sector, of course, has emerged as one of the sexiest sectors, if you will. It's at the top of many institutional investors' lists. Others are looking at niche property types, student accommodations, senior housing, self-storage, data centers have all been capturing far more dollars as investors are looking for new ways to invest their capital when trophy assets in the major markets are so richly priced. The other alternative is to look at secondary markets. And I'll show you, this is our data for the US. And this table shows the 6 major markets in the US are Boston, New York, San Francisco, LA, DC, and Chicago. Secondary markets are the next rung, and then tertiary are usually markets less than a million in population. As part of the axis going down, core stabilized, value add, and development and redevelopment. Again, it's riskier, higher return as you go down. So instead of going out the risk spectrum in terms of development or even value add, over the past year, there's been far more activity. While the market was overall down, the only positive we saw was core stabilized assets in secondary markets. There had been and continues to be a fairly wide discrepancy, gap in yields between major markets and secondary market asset pricing. And that falls across the property types. This bubble graph, the y-axis vertically is change in prices over the past year. The x-axis horizontally are changes in volume. And you can see the bubbles are actually scaled to the investment size of each sector. The farthest and to the left, the most positive sectors have been secondary apartments, non-major market, secondary CBD office, suburban office in total. Suburban office has been a laggard of all the property types in the US since the GFC. And so there's so much more attention focused on that, both in non-major markets and major markets, as well as the retail sector. The sectors that had been on fire, CBD, major market office, CBD, major market apartments, starting to slow. In fact, if there is a small correction of prices, we've seen Manhattan apartments, probably just a few basis points, but that is a market that we've seen a small correction in. So of all these uncertainties in the marketplace, there is one certainty that I'm very confident in, is expect more capital. Even though there have been declines of transaction activity, it is not a weakness in the capital. When you look at, this is not our data, this is Preqin's estimates of dry powder among the real estate funds. And you can see that it is, if you include the new debt funds, as high as it ever has been. When you look at other surveys of target allocations, whether it's in Asia, Europe, or the US, institutional investors are below their target allocations. There are new allocations being established all the time. There are some huge behemoths, particularly out of Japan, that could enter the market and be as significant as, say, Norges Bank was a few years ago. So there are other heavyweights like that. So, if there's one thing I can caution you, this cycle, I believe, has some legs. Again, investors are being very heightened, sensitive to risk. They're not ignoring it. There are a few pockets in the world of overbuilding, but on a macro basis, and certainly in the US, we're not overbuilt. In fact, the trend is going backwards. There's more discipline there. And we're not seeing overleverage, the type that certainly would make more sellers come to the market and sell at cheaper prices than they ordinarily would. And the weight of all this capital that's on the sidelines and continuing to accumulate is going to be a very stabilizing force. That weight is going to keep trends moving roughly positive, maybe not as positive as they've been over the past 7 years, but probably in a positive direction. And if we do have some outside shocks or recessionary influences, the weight of that capital will probably keep those downturns relatively shallow and brief. So with that, Brad, I would like to turn it back over. Thank you very much.